important. And so I want to explain, I guess, for people who, because people who are listening today are at various stages along their journey. And so I want to sort of explain that although I did have relatively good technical analysis skills, and they are the same, there's a difference more in the approach, a little bit more in the mindset that's different between the way that I used to trade. So for example, let me explain this so that it makes sense. I would be focusing on a strong trend on a higher time frame. So let's just go and I would we'll pick something like, I think Pound Aussie was pretty good, or Euro Aussie had some strong trends. So you should be able to see, let's see what Euro Aussie, which one was I looking for? So if I go and have a look at some of the daily charts, I actually had one in specific, was a Puncad. Okay, here we go. So what I would do is, this is the previous approach that I would use, which makes sense, but it has a couple of holes in it, which was find a really strong trend on the daily, then go and look for a potential entry on the lower time frame. So the idea would be then to go and look for potential entry on the 4 hour or the 1 hour and the 2 hour, and that works and that makes sense. But since COVID, since lockdown, my day trading approach has become its own standalone activity, and there are differences between that previous approach and now. So one of the biggest differences is that, for example, what I wouldn't have done in the past was that if the daily chart was in an uptrend and was doing a retracement on the daily, I would not touch that for any counter trend day trades. So I wouldn't want to expose myself to what the higher time frame trend was doing, and I wouldn't want to risk it. So that was the first problem. And the reality of the situation is that when a market is very overextended and it is doing a correction, there are high probability valid day trading opportunities on the lower time frames. And then there's a whole lot of other stuff. So for example, we do want to look at the 4 hourly for direction. So what is the logic behind looking at the 4 hourly for direction? Well, first of all, and I think I can shrink this back and we'll go find something where there's a change in trend. The 4 hour, because of the day trading opportunities I'm looking at today, they're all going to take place within 2 or 3 4 hour candles. Think about it. If I'm at my desk for 8 hours, that's 2 4 hour candles, and that's already quite a bit. So the problem with the previous way of thinking was that it didn't take into account that there's only 1 or 2 4 hour candles today where all my opportunities are going to sit within. And so for day trading purposes, there are actually a set of rules. The rules should be generally that the 4 hour will give you a direction, and that you would look for an entry on the 15 minutes, the 5 minutes, or the 1 minute. So in other words, day trading makes sense that if I am wanting to take a position today, and it is really just for today, then my window of candlesticks and price action data that I'm looking at actually really shrinks right down. So almost in a way, it doesn't really matter so much where my support resistance levels are on the daily. This is a big change. In the past, I'd have monthly, weekly, and daily support resistance levels. But now I'll be looking at the 4 hour in isolation. And all I'm really focused on is where are the nearest major market structures on my 4 hour chart. That's all I'm concerned about. And the reason is because I'm looking to take advantage of the 4 hour moves between major levels. So let's talk about the chart that's right in front of us. So Euro Aussie is currently stuck within a range on the daily. You can see it's actually coming down towards the bottom of the range. Let's put it there. And you can see the top of the range here. So this is a bit of an issue immediately because we're sitting quite close to a level of support and on the daily. So we go down to the 4 hourly. Let's see what that looks like. When we look at the 4 hourly, the problem we have is that although we could see prices really testing the lows, there isn't anything currently in motion. The 4 hour is sitting next to a major support level and within a range, which means that there's no real motion. Right now, it's sitting at that edge and it's bumping its head up against it. So it's only worth something to me if it's going to turn around and work its way back up to the top of the range, or if it breaks out of this box. So in other words, I'm looking for a 4 hour chart that is already in motion. But that's really important, guys. I'm looking for a 4 hour chart where it is already in motion, meaning there is already a candle that is broken out, which tells me, holy cow, it's broken out of the range to the downside. The momentum is now shifting to the downside. or vice versa. Because what that tells me is that, okay, if I'm looking to take a trade over the next couple of hours, I really need that 4 hour to be in motion. The danger comes if the 4 hour is very much overextended. If we use this as an example, and let's just say that I was looking at this 4 hour candle right here, you can see that we've already, if we go back into its history, we've broken through this level of support here, and we've had a big move and another big move and a little bit of a consolidation and another big move. And so if I just looked at all of those, logically it tells me compared to the previous 30, 40, 50 candles here, this is a big move, and it's technically has traveled a long way. And so it's safe to assume that it's probably overextended. It probably became overextended after this candle. So by the time we had this candle, these candles, it was already overextended. So the problem with that is that now the risk of it doing a correction or a retracement on the 4 hour has become increasingly probable. Is everyone with me so far? Is this making sense? So my goal is to find a chart where the 4 hour is ideally in the very early stages of moving or is on the move and is not overextended and is also not stuck in a range. That means that if I take that trade on the 5 minute, the 15 minute, the 1 minute, these are concepts, but they're really important ones. The chances are that I'm going to get some movement. So some of the best setups are when a 4 hour has just started moving, which is why we often talk about, let me show you this. So I'll set it up. I'm just grabbing something here quickly. Which is why if we go through to the market here, and so it depends I'm curious, I'm more interested and curious than anything else, it's not a judgment. Who's listening here today sits in a completely different time zone, Australia, New Zealand, Singapore, or the US. If you're within 3 or 4 hours of the UK, you're roughly, or South Africa, you're still within the same time zone. But is anyone sitting in an obscure, in a time zone that's 3 or 4 hours difference to London? I'm curious. And where is that? So if we go down here to the bottom, you can see we've got these different sessions. There we go. Don't be shy, by the way. Everyone's very shy. So this is where we are. And so usually, as I said, I would be, in the past, I used to get up really early. So I was up at 6 at my desk. And then I noticed that really the momentum would often pick up only at 8 when the UK session kicked off. That's when suddenly the markets would start moving. And prior to that, you can occasionally get moves. The market might do a small move on that 1 minute, 5 minutes, or 15 minutes, but then it would die or it wouldn't hit its targets. I usually find that stuff that starts moving at 8 o'clock, they have a higher probability. And so this little window here where you go from sort of 8 to 10, 9:30, 10, that's where a lot of the moves tend to happen. And then after that, there's a little bit of a sort of a sluggish period where only maybe the stuff that's really trending like crazy might keep going. Otherwise, it then starts to kick off again when the New York session kicks off. Okay, so when the New York session kicks off, then we tend to get a flurry of activity. And then after about 3 p.m., for the most part, it tends to die. So let me sort of go back and state a few other things. I often find that between 10 a.m. and say 12 o'clock, the setups can happen, but they're not on an average day, on an average week, they're not as great. And again, after 3 p.m., strangely enough, after 3 p.m. to 5 p.m. on an average day, on an average week, there's not as many setups. So if I'm waiting for the 1 hour to retrace or I'm waiting for the 4 hour to do it, yes, possibly. But if I'm expressly looking for a high probability fast move on the 1 minute, 5 minutes, or 15 minute, those sessions become the most attractive where the overlap is and there's an increase in volume and an increase in volatility. So hopefully everyone's with me on that. Okay, so that then makes that decision for doing that. And usually once you find those trades, you then are in those trades, you get into them, and then you just wait. So they might close out. If I get in on one at 8:15, it might close out at 10:30 or 11 o'clock or 12 o'clock. Okay, it can happen. Excuse me. And also what I want to do to make my trades the safest, when I use the word today, when I talk about safe trading, I'm talking about, relatively speaking, as safe as it can get, as safe as it can get if you're managing tigers. Okay, if that's what's going on. So again, I'm looking for a strong 4-hour move, not overextended, and then I'm usually looking to take advantage of it. So if we go to, I wonder if I can, if it's a better one, if I can draw it on, let's get rid of that. Let's go here. Let's see if I can do it. So yesterday, we were actually looking at pound Aussie, I think was one of the ones we were looking at. So if I go down to the 60 minutes, we were actually sitting, I believe we were sort of sitting over here. That's it. We were looking at it over here was that period we were looking at. And really the idea had come. So if we go look at it from the daily, so let's get some perspective here. From the daily, price had become overextended. And we had produced a swing low. So we produced a swing low, which means that there's now a high probability that pound Aussie was going to work its way up to the very nearest support resistance level, which would either be somewhere around 1.9181 or possibly 1.92, somewhere in that area, even as high as 1.925. 250, yeah. So we were talking about this yesterday. Now okay, so some of you, was anyone actually in that session yesterday? Does anyone remember me going through that stuff? But anyway, so we were looking at that. And so the beauty of it is we had that confirmed swing low. Now the question really becomes, because that's what trading is. Trading is about how the market has a couple of key levels, all right? And then ultimately travels between them. Okay, so it comes up here, if it breaks through, then it might come back and test this. If it bumps through here, it might break through here, then it might come back and test this. So you get, it's really how the market will tend to operate by going between those different levels. And so we were wanting to take advantage of that. Are you guys trying to talk to me? I'm not really getting many updates here, so hopefully everyone is alive. Okay, so let's continue here. So that was the basic logic. I went down to the 4-hour, and so we were having a look at this yesterday, and we had seen that price was attempting to break out. If I recall correctly, I think we were sitting over here, so this is yesterday. That's right. So we were in this particular area and the price was really wanting to break out. And if you look at it now, it's actually become a bullish engulfing candle. So one of the things that we want to signify that there's been a breakout, ideally, is a breakout to the upside would be a nice green bar that closes outside of that range, because this is a range. So this is a range that looks like this. And the market had gone from trending down to a sideways range, and combined with just this very consistent, steady, bullish uptrending move on the MACD. So the MACD has now started to bullishly diverge away from price. How many of you are comfortable that you understand reading divergence? Because you can use any momentum indicator, RSI, Williams percent R, stochastics, CCI, or MACD, for example. How many of you are comfortable that you feel that you understand that? Drink. So basically what's happened is the market has been consistent. Look at its very, very rhythmical trending lower. Looks really good. Not too much gapping, not too much spikiness, not too much erratic behavior. It looks relatively orderly. And the orderliness of a trend adds to its safety to trade, because it's just very nice and systematic and orderly. But something has changed over here. We've started to get fresh lows in price. So we're starting to get lower lows here. But at that exact same time, the MACD has now started to climb, okay, over that same period. This is not bearish anymore. And so that bullishness, that uptrending on the MACD or on the momentum indicator is basically telling me that this downtrend has become exhausted. It's tired. And it's very tired. Okay, so if we go again, and this is the way we do it in the city, it's a very reliable way to read these indicators. So again, we have a trend. The market's going sideways, and then it takes off. So it's nice and steep, shallow retracement, big move, shallow retracement. Now the angle changes. Angle's not as steep. Retracement's a bit deeper. Angle's not as steep. Not as much of a big high. Deeper retracement. Not as much of a new high. Deeper retracement. Then eventually maybe it breaks down. Goes down quickly. Small retracement, angle's quite steep. Small retracement, angle's quite deep. Now it's suddenly not as steep. and so on. So we get this angle, this angle at which it's moving, the depth of the retracements, the moves, the size of the moves all start to shift as price goes up here. So it's very aggressive. It's a brand new trend, nice and strong. And then as it gets more and more tired, it gets deeper retracements and it's not creating such fresh highs. But there is this moment. Up to about here. So there's this moment up into about here where it's still creating fresh highs. Price is still creating fresh highs. But meanwhile, the indicator has been doing this. So the indicator was trending higher here while price is going up. And then as the angle of price here starts to change from this angle to this angle, this starts to diverge. We get this weird patch where this is still producing higher highs, but this is producing lower highs, and it's called bearish divergence. So it's diverging away from price. And this is a very reliable indicator that a market is losing steam. It is not saying to you it's going to change direction necessarily. It's saying to you, maybe you don't want to keep buying here, because it's your worst fear as a newer trader is that you find a trend, finally you get a good trend, and Sod's law, Murphy's law, you get in, and that was the very last time that the trend continued. Okay, then it changed direction and you had a losing trade. Sorry, this is sparkling water, by the way, flavored water. It's very cool. This is brought to you by Dash. It's this bearish divergence is a very reliable indicator of the strength of the trend, and also potentially a heads up to if there is going to be a change in trend. So it's very powerful. We can use it, and I've done previous webinars with Simon on the MACD and using it appropriately. So they exist. I don't know if you have them somewhere, Simon, but also I know that in Finico, for example, we put them on the YouTube channel. So they're great for alerting me to potentially when a trend is running out of steam, but also to when there might be a new trend on the horizon, but I need price action to follow through. So you never use it as, it's not a buy or sell indicator, it is, or signal indicator, it is, a criteria that forms the basis. Now price action, we always follow price action. So if you ever have to choose between what an indicator is saying or what you're hearing in the news and what the price action is doing, you always go with the price action. Always, always, always. In fact, the greater the contradiction, if the media is super, super bearish, but price action is producing high lows and high highs, then you go with the price action. Okay. Because remember that the price action are physical orders going through to the markets. That's why it's so important. So we've got this bearish divergence, and here what you can see, which is the inverse of that. So let's just get rid of this stuff here. We go back to this, you can actually see that we've got these fresh lows, but this has started to produce higher lows. Then the market starts to go into a bit of a sideways mode, and actually what it does, a little bit, maybe not necessarily obvious to you, but it sort of produces a bit of a double bottom. And one of the things that's a really good sign in a double bottom is when you get a very strong bullish engulfing candle. So it engulfs some of the previous ones, but it's a nice strong bullish candle. That is often, not all the time, but a solid 70 to 80% of the time maybe, is a good indication that the market is going to bottom and turn around. And we can see that MACD continues to climb. Okay, so this MACD is continuing to climb. It's still bullish. And in fact, now what's happening is we're now almost in an uptrend. We've gone from a low to a high to a higher low, and this is trying to shift. One more observation that I would make that I don't think I made yesterday, but I would make it, is if you just look at this generally speaking, price is below the red 50-period moving average. So it's below it. Generally, that means it's bearish. What you can see it's bumping its head, its head up against now is trying to get above that 50-period moving average. And once it does, boom, then because traders are looking at different things. Some traders are looking at support resistance levels, some traders are looking at fib levels, some traders are looking at pivot points, they're looking at candlesticks, they're looking at moving averages, they're looking at price. So what happens is as it starts to get above the 50-period moving average, it'll also get above a certain price, probably get above a certain support resistance level, and so more and more traders will look to join in, so it starts to pick up momentum. And this is what it's trying to do. It's trying to break above that. And if it does, then it's likely to head up to this next key level, which I've got up here. But for the moment, that is what it is trying to do. Okay. And so we've got that bullish divergence. That's what it's trying to do. And so The reason I'm showing you this is because I'm trying to determine if there is an early opportunity into a new trend, if it's going to go to the upside. So if I had to trade situations like this all the time, there'll be some that will fail. Potentially here, they might go sideways for a bit and then carry on down, but most of them will actually ultimately succeed in going to the upside. The more overstretched the dailies, the more overextended the daily is, the more likely it is that it's going to go my way, because the market's heavily overextended on the daily time frame. Therefore, and when you have a daily retracement, ladies and gentlemen, your daily chart will retrace for 2, 3, 4 days. So you've got 2 or 3 or 4 days wherein there might be a couple of day trading opportunities on the 15-minute, 5-minute to the upside. So the most important thing is we identify where those key levels are. We need to know that, because we need to map out the lay of the land to know where we've got some room to run before that daily has now become retraced. Does that all make sense? So we definitely want to keep an eye on that. And we don't want to assume with technical trading, you're very good at, technical traders are very good at predicting the next most likely place the market is going to go to. The further away we try to predict, the harder it is to actually predict that. Then it gets difficult because it needs more time, and as more time passes, things can change. So we're looking here for an idea. This was yesterday, and I'm just carrying on. It's a breakout and a pullback and a continuation. And now that I'm live with you, I can update it. It basically does appear there's our range, but this also appears to me as though we've had our pullback here. That was the breakout. So the previous line, I drew that yesterday before price had even mapped it. And now you can see prices come back. So what I'm seeing here is this candle here becomes, we've had a bit of a breakout and a pullback and a nice little green candle here. This could be a potential higher low before price continues, which means that I could be using we could be looking for a trade opportunity right now. So this is going to be a bit of a battle. This moving average and any price levels we have is going to be a definite battle. When we go down to the 60-minute to the 1 hour, it's going to be a little bit easier to spot. So I'm going to remove this just to get it out the way so we can see what's going on here. And here you can see there's a bit of a band there. Boom. It's a little bit of a resistance area that I need to be careful of. It coincides with that 50-period moving average, but this is an area I need to be a little bit more cautious of. So now what I'm going to do is I'm going to go back up to that. So yesterday I spoke about this idea, and I'm going to repeat it. Apologies to anyone who's not interested in that, but I'm going to repeat this. If we have a nice, strong, bullish candle here, you'll see the candles often overlap. Candles often overlap. Okay, they don't always tip to toe or whatever, edge to edge. So here, for example, even here, you can see they overlap from that high to that high. They overlap there. Okay. Over here, for example, even here. So this closed over here, went all the way down here, came up here, closed. This one opened, went up a bit, and carried on down. This one on the way up, it went all the way up to the little high there, then it came down and closed here. This one opened, went down, went up to here and closed. So all of that makes sense to you. So this is actually a great example. This is what I'm looking for. So in this particular case, there's this amazing overlap. I'm going to put a box on it. The box is from the high here to the low there. There's that overlap. So this candle came all the way up to the high here, closed here. This one opened, went down to this low, and went up. Is everyone with me so far? So there's this overlap area. And that's on the 4 hour. So on the 15 minutes or 5 minutes, that is likely to be that move from when it opens to down to back up will be a temporary downtrend on that 5 minutes or 15 minutes. Slow move and all the way up. And you could even argue that once we break above the high of this green candle, so once price goes down, I'm going to get rid of this. Once this candle opens and goes down, turns around and starts going back up, once it goes past this point or even past the high over there, it's now definitely the buyers in control, and the next candle is going to push through. So in isolation, I'm going to give you some amazing, amazing tips here worth their weight in gold. Whether you believe them or not, that'll be the case. We'll see. When you get a really strong bullish candle, and you don't even know what's happening before it. So think about this. You don't even know what's happening prior to that, but you get a really, really strong bullish candle. What is the next candle most likely to do? If you get a really strong bullish candle, what is the next candle most likely to do? Now, let's say that the next major level's up here and the previous level's over here. So in other words, there's nothing in the way. Do you think the next candle is most likely to be a green candle pushing higher, or is it going to be a red candle? Now, yes, it is possible it could be a red candle. It is possible. But if there's nothing in the way, if there's no resistance for the next green candle, the path of least resistance is probably to the upside. If this current candle is nice and bullish, the next candle might follow through on it. Okay. We're talking now. Let me show you as well. Let me add to that. So we take that same idea. Imagine we have a consolidation and we get a bullish candle breaking out. So this bullish candle is not overextended. It's literally the first breakout candle. It's the beginning of a potential new trend. The second candle after that, is that likely to follow through on that breakout? Statistically and probabilities wise, yes, it is likely to try to follow through on that. So yes, there's a moment where it'll drop down initially and then pick up and carry on. So this is all on 2 4-hour candles. So here's what we're doing. I get that strong 4-hour candle that closes. Now I'm waiting for the next 4-hour candle to come down, turn around, and start heading up. And that's where I'm going to be looking for my buying opportunities on the 15-minute, 5 minutes, 1 minute. So notice the next 4-hour candle is doing its thing. It's opening up, going down a little bit, coming back up, and then ideally following through. But I'm getting in on the much lower time frames in detail. It's granular, and I'm looking to take advantage of that move up there. So conceptually, that's all I've done. And so where the daily levels are, what the daily's been doing, what the monthly's been doing, are not really that relevant for my for that 4-hour candle that I'm going to be following, unless the daily monthly is at a major level. So if it's at a major level that's historic, and if it's overextended, and if there's divergence, then there's a whole lot of other reasons why that's not going to work. So generally, as long as I am between 2 levels and the trend is relatively strong, it should continue through, and I'm going to take advantage of that. So here's where we are. We now had price manage to break out of here. And actually what happened yesterday, during the session yesterday, it was trying to break up and then it turned bearish. So we'll go to the 60-minute chart. And where was it? Was it here? It was over here somewhere. We started to break lower. So it got down to the 15 minutes. It was this. A bit of a consolidation here. We had a consolidation in this area. We hit market structure. This was all in yesterday's session, which I think Simon will provide you with a recording for. Session there, we had this breakout candle, which basically said, I can't get out this way. I'm going to go back. And then it proceeded to work its way down. And we highlighted these 2 levels as areas where, or we highlighted actually we highlighted this level or this level as areas where. So remember, let's recap where we are now. We're on the daily. The daily is overextended. It is producing a swing low, which means that if that swing low holds, it's going to retrace for 1 or 2 or 3 days back up to the next major level of resistance. And all we're looking to do is just see if we can get today or yesterday a trade in that move. We then go down to the 4-hour. On the 4-hour, we can see bullish divergence creeping in, prices going sideways. It's in a range, and we can see prices trying to break out of that range. So the timing is perfect because we're getting to this point where it's going from a downtrend into a bit of a sideways range, and now it's trying to break out of the range. And that's that swing low that's forming on the daily and that momentum. So we know we've got some room that it's going to run to before it gets to the next level. And so that's what we were trying to see yesterday. We were trying to break out of this range. The range was actually like all the way to there. Tried to do it, and while we were talking, it broke down, and ultimately it came all the way down to here. This is now in the late afternoon, and we end up, by the time I go home, by the time I went out last night, we now have the markets recovered, and actually now it's breaking through here. So it breaking through here, does that add to the idea that that daily is turning around and the 4 hours managing to break out? It does. But I wasn't here to trade it because I was out, went out for the day. So we had this big move, price breaks out. This is on the 15-minute time frame. What I want to do is I want to go back and look at what this looked like. What did this look like? So go back to the 4-hourly. Is everyone with me so far, by the way? And so what we got after yesterday's session, we got the move down, and then it reversed into a bullish engulfing candle that also broke out of the range. So does that support our trade? Because we've got a narrative, and that's what we're doing. We're creating a story in our mind that this is what we think the market is trying to do. And if it produces these signals, then that is still in line with that story. If it produces different signals that don't support that, so suddenly there's a big red candle that breaks down here, then the story is changing. But as long as it keeps producing signals in line with that, we're good. So actually, this is what happened. We closed yesterday, 4 o'clock or whatever, with this candle. It went up a little bit higher, so it followed through. And then overnight, came back down. And today, it's produced this bullish candle. So is the narrative still holding? Yes, it is. Because on the 4 hour, what we appear to have is a breakout of the range and a pullback and a retest. That's a very, very common pattern. Price will bump its head, come back, break out, retest, and carry on. That's very, very common. And so that appears to be what we're seeing now. Pullback, bullish candle, which means the next candle has to break the high. And actually, as it happens, the next candle has broken the high. So this appears as though it looks like it's going on. And our whole idea was to see if we could get in, capture a trade somewhere in this area. The only thing that isn't ideal, so I'm going back to the 60 minutes, isn't ideal, is this is a level of risk here. I wouldn't mind a free run. So I want a free run up to here. This is where I want to capture my trade. But let's also look at the current price action. We've pulled back here. We've got a series of high lows. We've got a nice bullish candle here. We've got a consolidation. And we've currently got a nice bullish candle forming over here. So let's talk a little bit then about risk. So once you have your idea for the trade, okay, so there's just, commenting on moving averages getting in the way. Excuse me. This could close as a nice bullish candle. It's safer for me to get in after it breaks through this level. Safer for me to get in. But the problem is also then I might not be able to capture a piece of a move here. Safer. Alternatively, I could take, and it's higher risk. It's higher risk, but it's not completely crazy, is this candle here becomes my entry candle. So if that closes as a green candle, like it is now, I could make a buy with my stop loss below that low or below this low. So both of those areas are valid for my stop loss. That's valid. That's valid. Ideally, I want my stop loss as close as possible so that I can get my 3 to 1. I can get my 3 to 1 because I ideally want to get 2 or 3 to 1 before I get to the top of this. So what we're doing in today's session, I could be looking at a whole lot of stuff, but what I really want to do is it's a bit of a Miyagi wax on, wax off. I'm spending a lot of time talking about how I identify a trade setup. What is the logic rationale behind my trade setup? Which time frame I'm choosing and why? What am I looking for? And so I'm jam-packing a whole lot of price action stuff plus market structure plus where do I put my stop loss? Where's my risk management? How do I accept that this could still be a losing trade? So I could get in here, price could go up here, fail, come down here, and then break through and go. That is a possibility, and I have to accept that. And that's where the risk comes in and the mindset. I've identified how it could go wrong. And therefore, I've allowed that. Therefore, I'm maybe not willing to put 2% on that trade because this is a potential problem. We can see that it's a problem. But I also think we're very likely to go up to that level. So I could put half my risk on here, half my risk here. And if it goes, I could then maybe add another half in when there's another pullback. And if it's a losing trade, then I've only lost my half. How confident am I the price is going to go up to here? There's a different way I would put that. Instead of saying, how confident am I the price is going to go from there to there, I would say, how confident am I the price wants to try to go from here to here? Very, very. There's so many indicators that show me the daily needs to retrace. Price action is supporting it. The bullish MACD is an added bonus. There's a lot of stuff here. But it could try and fail. But I can tell you that it really does want to at least try to get there. So because of that, I've accepted the possibility of how it might lose, why it might lose, but I also know my trade idea is not crazy, it's not stupid. If I put my stop loss here, I understand the price could come up here, hits its head there, hit me out, turn around and go. I accept that, I know that, I understand why my stop loss would be there. But if it goes, I hit my 3 to 1 relatively quickly. So this is risk reward. My risk is slightly higher, but my reward is also slightly better. In other words, it sort of neutralizes each other. Alternatively, so I could have something like this happen. It gets up here, comes here, goes like this, this goes, does this. Those are all valid ways in which it could do that. It could also do this. It could break through here, do this, break through this, and go up there. Those are different ways in which it can play out. So if I want to wait for it to break through a major level, then I could wait for it to break through and try to get in on the breakout here or a pullback in this area. Only problem is, if my entry ends up being here, I'm not going to be able to get a 3-to-1. Do I just, not take the trade? No. I'll take the trade. It's the probability is still very strong that it's going to go up here. In fact, whether my candle is over here and ends up being this big, so that's my setup, or maybe I end up getting it anywhere else, the probability that the move is going to happen actually hasn't changed. It's still the same move. It's still think it's likely to come up here. It's really just the candle or where my entry is and my stop loss that has ultimately changed. But the probability of the market playing out is as random or as high probability or low probability as the next trade. So I kind of muddied the waters there. Let me go back. This whole trade idea is a high probability trade idea. And the probability that the momentum is going to ping pong it's going to get here, but whether it does this or whether it does this, I don't have control over it. That's random. But I do think it's going to work its way up here. So if I'm nervous, if I've had a series of bad losing trades, I might wait and go, you know what, not today. I'm going to wait till you break out and then I'll get in. Or maybe I've had a really good series of runs. I'm up 5% for the month. And I'm like, you know what, I don't mind putting 0.5% on this trade idea. And if I do get stopped out, then I'll wait for it to break through, or I'll change. So it's really important that I want you to understand how in each situation, we're qualifying the trade idea. We're deciding where our entry is likely to be, how it could play out, where our risks lie. And our risks lie and how it could fail. And also a very important exercise that I'm showing you here in real time is the simulation. I'm playing it out. This is a key criteria for success in sports, is visualizing how it could play out. The reason that's important is that it allows me to pre-plan where my exits are, whether I take profit or whether I exit the trade if it goes bad. All right, so if the trade goes bad, it goes bad. That doesn't mean it was a bad idea. This is a good trade idea. It's sound. There's reasons to take the trade. There's a lot of evidence that supports it. Now, you might not know that because you just don't have the experience, but you will get the experience. There are only so many ways this can play out. I can say, for example, that if it breaks below this low, we're back in this range again. If it breaks below that low, we're back in the range again. So and I think it's highly dangerous to do this. I don't do it, but some traders like to trade without a stop loss. Or I would put my stop loss here. If you just had a series of losing trades, you're like, I can't stand another losing trade today. Either don't take the trade or reduce your risk or move your stop loss out. But each one has consequences. So if I put my stop loss there, if the market goes there, it's definitely not going to go my way. I could also put it here. I could put it here. And probably if it goes there, it's not going to go my way. So it leaves me with, put my stop loss here or here underneath this support resistance level, put it there or there. And again, if it keeps going, great. Fantastic question. So can I please explain how I rationalize my target profit levels, please? Do you use support or resistance or particular indicators? Support or resistance, market structure. So in this particular case, I actually did look at the daily. So when I looked at the daily, I was identifying this area over here. You can see actually there's a little bit of a bad batch over here, but I'm focusing really on this. So this area to me is the first area where there could be potential resistance. How likely is it the prices could go up through to here? Very likely. It could. But I don't want to, what's the word, trick myself into thinking it's definitely going to go up there. This is not going to be a problem when it could get up to here, hit the moving averages and turn around. So in other words, I've put the first initial support resistance level where price is almost certainly going to go. And then the next one where it has a fair possibility it's going to go, but isn't guaranteed. So again, it's safer because I'm looking at, if I had a ball and I had to throw the ball and I had two distances where I could hit it, and maybe one was 40 meters and the other was 80 meters, I'm very confident I can get it to the 40 meter. I'm not as confident I could get it to the 80 meter. So, because it's windy or maybe the weather's going to change, who knows. So now we go back down to that 15 minutes. So we've kind of got the logic behind it. You can see actually this is where it starts to get really pretty to me. We have produced a little bit of market structure here. So price has got support here. What is this? This is a double bottom, guys, which is also good. So it's too late for me now, but that could have been an entry. It's too late. It's a hindsight setup. This is a hindsight setup. You get double bottom bullish candle here. You enter on the break of the high of this candle. Stop loss below the low here. It's below the double bottom. The whole bullish idea. Like basically now, this is a really crucial moment. So let me slow down and say this. I've now reached the point, after all the analysis I've walked you through, that any bullish signals now could be entry opportunities. I'm going to repeat that. Because I've reached the point where I feel the momentum is starting to move to the upside, almost any bullish signals now could arguably qualify as entry signals. Therefore, if I look, we get a wick here, double wick here, price comes back, we get a little bit of a wick, another bullish candle, another bearish candle with a wick, and another bullish candle that closes above the highs of these. That to me is now a series of bullish signals. It's a double bottom. Price is starting to take off from here. Therefore, I could get in on the high, a break above the high of that candle, and I would put my stop loss below the low of this, maybe just below the market structure here. And this could now be my very first entry. However, I missed it. I missed it. It's a bit late. What happens if I get onto the 1 minute? On the 1 minute, is it possible that there's going to be a break, a pullback, a break above, a retest, and a go on the 1 minute? So now there's this behavior, which repeats itself. That's all the market really does. So I'm going to go in here. What's happening here? So let's go to the 5 minutes. Here we go. We've got price going from a downtrend, breaking the highs here, potentially starting an uptrend. So I'm basically expecting to see if the market's going to head its way up. You can see it's battling here. Lots of little levels. Basically, you're always going to have that. The trend is trying to break high, and it bumps its head, pulls back a bit, breaks through the level, or bumps it again, tries to break through, bumps its head. So we've got a little bit of a level here that I think you can all see that looks a bit shifty. So there we go. Okay, it's a little bit of a level there, but also we've got this possibility. So how could this play out? Well, I'm on a 5 minutes. So this could do this, there, and go. That's a possibility, which means that could provide me, if this ends up being a problem, that could provide me with a setup. Maybe it'll pull back here. So instead of going where it's going now, it'll do this, pull back to the moving averages and do that. And I could get a setup over here. So I think there was a really crucial moment 2 minutes ago, 3 minutes ago, where I said, now that I've determined that it feels to me as though it is the tipping point is occurring and it's starting to break higher, every bullish setup becomes a potential buy entry. Let's go to the 1 minute. So it's battling in this area. It's battling. You can see it's battling in this area. It's trying to get through. And you can see the battle it had over there. So we've got that area is a battle area. And this area is actually going to be a bit of a battle area. But we're going to see now. So this is a move and a pullback. This immediately, ladies and gentlemen, is a pullback. There's my bullish candle there. So targeting 3 to 1, a break above the high of this would target 3 to 1. So I'd be in now, hypothetically. We're going to watch this while we talk. So that is an uptrend, it's a pullback, bullish candle, and it's a pullback and a bullish candle. So therefore, if my entry is above the high and my stop loss is below the low, this could be an entry opportunity. So all of this really hinges on the idea that I'm of the belief that now the market has started to slowly but surely break higher. Would I have entered the trade on the bullish engulfing support on the 5 minutes? So let me go back to the 5 minutes. Like this one, if that was a bullish engulfing candle, yeah, you could. You could, guys. I'm trying to free your mind. This is one of those, just confirm for me that that's what you mean, by the way, if this was a bullish engulfing candle, or if you meant someone earlier, if you meant something earlier, like this one or something. So it's a little bit, I have the benefit of I've lost plenty of money on my journey to get to consistent results. 5 minutes stochastics indicate more downward pressure. Okay, but we're going to have a look and see. Cool. It's battling with this area. This is a real issue. So let's go back to that 1 minute so we can see what's going on here. If it breaks this low, then it's a losing trade, but it doesn't mean that it's a bad trade idea. So I'm just going to pull that. There's my stop loss there. If we break it, then it's a losing trade. However, let's keep going with this, because if, again, I'm looking for bullish signs here, I stand by this. So, because over time you gain confidence, not just because you go, you know what, I've done that 1,000 times, it doesn't work. So you gain confidence from things not working. You learn to eradicate eventually. Like in a perfect world, you'd sit next to 5 or 6 traders on the trading floor, and you would just be able to mimic what they do, and they would stop you from doing stupid stuff. So your journey of working your way through what works and what doesn't work would be so quick. It would be 3-6 months maximum. You've tried everything. They've told you don't do it, it doesn't work, and they've shown you what does work. And so your process would be much quicker. But unfortunately, it isn't that way. But over time, what happens, where I am now as well, is my ability to go and to connect. In my brain, there's like 4 different things happening at the same time. What's happening on the daily, what's happening on the 4 hourly, what's happening on the 1 hour. All of that stuff is playing concurrently in my brain. But what I'm trying to do with you guys today is to break it down, slow down, break down why my brain is thinking the things it's doing, why I'm confident that this should go my way. And I think probably the most valuable thing I've said in the whole webinar today is that I've reached the point where I think the market is now starting to work its way up, and therefore any bullish signal is a potential entry point into that move. Because, yeah, that's what's happening. So, hello. And so there we go. We had our very first pullback. So also, here's what's happening. This is crucial. So now, let's say I've taken that trade. Let's say I've taken that one. Because thankfully, that actually happened with enough time for me to be able to do it. But here's the thing. Excuse me. I must not, and this is the danger that happens. Let's just say I go up and I'm up 2 to 1, 3 to 1. And in my brain, I'm going, I've got to work my way through this to get to this. Remember, that is my ultimate target. But what happens? Let's say this happens. Price goes up 2 to 1, 3 to 1, hits this, comes back down to, breaks down to here, and then works its way back up again. So this is why we take profit at 2 to 1 and 3 to 1. This is why we consistently take profit. Because even though I'm of the opinion that the market is going to go from where it is here, let me try and bring it all down. Jeez, it's a long way. So even though I'm confident the price is going to work its way from there all the way to there, that path is set with treacherous events. So much can happen while it's doing that. It can trend, then consolidate, then downtrend, then go up, then burst, then go to sleep. It can do so many different things. So we don't assume, just assume that it's going to go away. It's already battling. You can see it's already battling in this area. It's trying, but it's battling in those highs here. So let's see if that's the case. And so while it is on its way up to that high, there could be 3 or 4 3 to 1 setups. There could be a beautiful setup that goes 1 to 1, comes back, stops me out, then sets up again and goes 3 to 1. So there could, within that, there might be 2 or 3 setups. One's a loser, 2 are winners. And so this is really important. We understand that we are getting in, but we also understand that each trade we take is again not guaranteed. Even though I'm pretty confident price is going to work its way up to that level, I'm on the 1 minute, and this thing could dick around for half an hour before it does move. And so I could have 2 or 3 losing trades, and then it moves. So this is why we have rules that if this one goes 2 to 1 or 3 to 1 now, I take profits. In other words, I don't look a gift horse in the mouth. This thing is a tiger. And if you turn your back on it, and actually it's a good analogy, because when you turn your back on big cats, they do attack you. So as soon as the thing moves and I hit my 3 to 1, I close off the trade, or I take partial profits, and then I potentially look for another setup. Because as I said, I'm going to repeat this. There could end up being 2 or 3 or 4 more opportunities as it works its way up there. I might have to go. I might hit my 3 to 1, and then I've got to get a call. I've got to go, I don't know, go to the shops, go do stuff, and I can't take advantage of the rest. So traders, it's really important that you understand that unless you have a plan to actively take profit when it's going in your favor, you ultimately can't really start to grow your account. You have to kind of stick with it and go. There's a big battle going on here in this area to go. It should be moving, but it's stuck, and you can see the area. I'm going to adjust this a little bit, so adjust it to there, and now you can see the area that it's battling with. And that area that I've identified, that's market structure. And you can see actually, if you go a little bit higher, there's another one up here. But once it's trying, you can see it's trying to do that, it's trying to break through. And when it does break through, ultimately, it should then be successful. Should be able to then start moving and picking up that pace. Any questions so far? Great question. So the question is the strategy more scalping? I can do this on the 5 minute, the 50 minute, the 1 hour, the 4 hour. The logic, the technical analysis, the logic is scalable. So I wouldn't call it scalping. I wouldn't call it scalping because I'm targeting 3 to 1. Scalping, when people refer to it, by the way, is when they talk about scalping, they generally are looking for inverse reward to risk. Risk 1%, but if it's 0.5% profit, just take it. So I don't use the term scalping. I'm targeting 3 to 1s. I'm looking for momentum-based moves. I'm looking to take advantage of that stuff, and I'm taking profit. So yeah, so it's a good question because some people might just call it scalping because their definition might be, well, if it's on the 1 minute or the 5 minutes, it's scalping. But generally, scalping is on a very low time frame, and generally, you're just looking to get some profits. You might have a 10 pip stop loss, and you hit 10 pips, and you take it, and you're out. So scalping has a very, in my mind at least, a very specific connotation, whereas this is just trading. It's just normal trading. Any other questions, guys? I want to watch this. I'm hoping we will get to see it move up to here before we wrap up in the next 3 or 4 minutes. So let me recap without trying to annoy you guys how we got to this. We looked at the daily. The daily was overextended to the downside. It had started to turn around. We had a bit of a green candle. We had a red slow down, a bit of a green candle. We noticed that the next major level was up here, which is at 1.92 thing, is where the next daily level is. So if the daily does indeed retrace, it is, and this is another entry. So if you want me to tell you where the other entry signals are, this is another entry signal, that one. This is another entry signal, there. Both of those, now this is important. Does that make sense? Do you understand why those two are potential? Because remember, we're saying that any pullback or any entry, potential bullish signal is an entry signal. I'm expecting it to go higher. And any of those, I would have a 3 to 1 target, but the spreads would matter. What is my price level? So my price level target for this one is, I'm aware that there's some possible, so if we go back up to the 4 hour, is it the 4 hour? No, it was on the 60 minutes. So on the 1 hour, there's a level here that could be problematic there because of this behavior. So because of that, I'm a little concerned. I would ideally look to take some profit there or secure 2 to 1 profits and move my stop loss. Let's go back down to the 15 minutes, which is where we are. 5 minutes. There was a bit of a level here, excuse me, but now you can see this is really where my concern is. So as a general rule of thumb, all else being equal, my final take profit is 3 to 1, just 3 to 1. If my 3 to 1 is just on the other side of here, I might be a bit nervous because this is the resistance band. This is where we're potentially likely to have issues. So therefore, if I'm up here and I'm 2 to 1, I might take some partial profits. But if my 3 to 1 is ahead of this level, I'll just take it. I'm not going to worry about this. So what you're trying to do as a trader, you're trying to pick the stuff that is most likely going to go your way on every single trade. Trading is not about finding a difficult situation and trying to make the best of it. It's about finding a situation where it should be really easy. The market should do this. There's nothing that should get in the way, and then getting in on that. Okay. If you find yourself picking difficult strategies or fighting the market, there's possibly another thing going on in your mind. You're looking for a fight. You're looking for things to be difficult. You're looking to sabotage yourself. You've got to find things where the odds are in your favor. So I just want to check with everyone who's been listening in today. Oh, you're referring to the bottom of the highlighted area on the 5 minutes. Bottom of the highlighted. Down here, the bullish engulfing. There's a bullish engulfing. Yeah, you could argue that. Statistically, that is a valid setup. It's all right. Cool. So let's talk a little bit about this. This was price comes down here, comes back down here to test the level again, but it does something else. It comes back here, bounces, bit of a bullish engulfing candle here, comes back again, bounces, and then bounces again. These are all bullish signals. It's going down, and suddenly it starts producing a whole lot of bullish candles right at this level. And so that actually becomes a bit of a bullish signal, but you're still in a downtrend. So ladies and gentlemen, when we talk about risk management and psychology, this is a downtrend, and technically taking a buy is high risk, but it's the same idea. We've got that bullish signal is, and all of this collectively, price action wise, to me, it's a bit more obvious now. It's now looking, and that comes from experience. One of the things you might learn from is just watching the 1 minute. Just, you know, while you're having your lunch, just watch the 1 minute. Identify the key levels, and then just watch how the 1 minute behaves as it works its way between the key levels. Just that would sharpen your price action skills. So I could take the trade here. I could go and say, maybe not this one or this one, because that I could have taken this one. So I get in there, looks like a double bottom. This looks like a bottom and a bullish engulfing candle, but I would have got triggered in, stopped out. And actually that happens. So the next one that I see is this one here, which looks really good. Why? Because, well, you have this sort of U-turn here, and then you get a bullish engulfing candle here. So it's kind of like, it's still weak, and then it's pushing back. So where would I put my stop loss? Probably below here. Probably there is the best place. Because if the market drops below here, then it's not going to go my way. But if you had decided not to take that because you weren't confident, and that is a higher risk setup, we're still on a downtrend here. Putting my stop loss there means that it's a valid idea, but it's a lower probability. It becomes higher probability once we turn into an uptrend. Once we break these highs, I spoke about this yesterday. We break these highs, we break these highs. We've broken all of those. So what's happening is this downtrend now is not in play. Now we're in an uptrend. So that would be the earliest possible potential entry, but it's higher risk, lower probability, because we're still in a downtrend. If your brain is fried right now, that's normal. Really normal. And if you're getting, that's normal. And if you're getting what I'm saying, then fantastic. But the recording, if you go through the recording and watch it a couple of times, it will eventually click, because I'm trying to explain it very slowly. So anyway, and here it sort of breaks and pulls back and goes, and that's where we are. Now I just need at least to go up to here. Yeah, so let's see where the 1 minute is. So you can see it's battling here again, battling. So again, in this case, if I had gotten in on this one, that was my original, I think, wasn't that my, yeah, that was my original trade idea. There was my original trade idea here. And so we're getting close to hitting that 3-to-1, and it looks good. We should work our way up here. What would I recommend using the line bar to filter out the noise, wicks and stuff to mark up your charts for support resistance? Yes. So the question is, I could display my price action as a line bar, and I could use it to help identify support resistance levels. It's definitely a way to go. And I mean, as in I do that sometimes, yeah. Otherwise I just go, if it's obvious to me on the candles, I'll just do it. But if it's not obvious, I'll switch to a line chart is a better way of doing it. And trend lines and stuff here. But sometimes the candles do kind of explain it. This is really battling. So what's happening, this battle, Simon's back in, because we're going to wrap up. What's happening here, there's a little bit of a battle in this area, and that's a breakout and a fail at this point, or ultimately a breakout and a retest and a go on. But it depends. Okay, this is failing to break through this level. So we're probably going to see it come back down to here. So usually I would have done from here, I would have tried to take some partial profits. So it's going to come back down to here, and then we'll see if it can hold, and then it's going to go back up.
Oh.
That's it. That's it for me, Simon. So I hope you guys found this instructive and useful. If you give me these recordings, Simon, I'll repost them on my YouTube channel as well. I was going to say, if you want to kind of get a little bit more exposure here, go find my YouTube page, London City Trader, Adam Harris, London City Trader. What I wanted you to get out of this was price action training. So in this particular case, there's no reason to lose money on this trade now, because this is clearly a correction. I would have either closed this out now we'll do this. And it's quite interesting because you can see the failure there, and then you can see the close, and you can see that. So I wanted you guys to kind of, that familiarity with what price action is doing is pretty standard. Don't worry about it.